Hello and welcome to another Energy Connects discussion ahead of the Japan Energy Summit and Exhibition 2024, which is going to be taking place in June. In this fast-paced realm where the forces of supply, demand, geopolitics, and innovation intersect, the quest for dependable benchmarks is paramount. From crude oil to precious metals, agricultural products to industrial metals, traders, investors, and policymakers alike seek the bedrock upon which to build their strategies and decisions. To learn more about the significance of benchmarks in trading, I am very pleased to be joined by Joe Raia, Chief Commercial Officer at Abaxx Futures Exchange. Joe, thank you so much for being here with us today.
Thanks so much for having me, and looking forward to our second time at the conference this year in Tokyo to further engage with the marketplace on our new futures exchange and clearinghouse based in Singapore, and to introduce to them the innovative benchmarks and technology that both the marketplace needs and that we feel will be a game changer for the global energy community.
I'm sure it's going to be an exciting opportunity at the conference.
It will be.
We can start out by speaking on the difference between the benchmarks. So it's physical and financial.
Yeah, it's interesting. You have to go back, and it's, a lot of people look at past history or don't want to look at past history, but really the genesis of financial futures and the use of in a institutional way of financial futures went back to probably Enron, or just before they defaulted in the marketplace. They were a very active player in futures markets and also in OTC, over-the-counter bilateral markets. They used physical futures for hedging, but they also used financial futures as a basis to the benchmarks. And when Enron defaulted, both ICE and NYMEX, and I was at NYMEX at the time, developed a platform called Clearboard, which was a risk mitigation tool for the marketplace, taking financial markets that were, again, mostly traded bilaterally, and began clearing them as futures. ICE had a little bit of a different model back then. They were clearing them as OTC swaps. We were going the full futures route, which we felt gave better and does give better customer counterparty protection. But nonetheless, the marketplace did shift pretty dramatically, because when you look at the structure of futures markets going back to 2000, 2001, the Commodities Futures Modernization Act of 2000, which we were very much involved in at the NYMEX at the time, did give the marketplace the ability to basically not deregulate, but to look at other markets that were not necessarily physical benchmarks to become basis to the benchmarks. And so that kind of really started it. We started developing products on the Clearport platform in 2002 after Enron defaulted, and actually the end of May of 2002. So literally right around this time back then. And the marketplace said, listen, we know you have great physical underlying liquid benchmarks. The market wanted to use those and trade basis to them, or price differentials to the benchmark contracts. The NYMEX back then only had about 5 physical contracts. And so now we were starting to look at these financially settled products that were based on indexes, based on price reporting agencies, as a means to help grow the marketplace, help mitigate counterparty risk, and really help the market get out of the problems that they had during Enron or after Enron. So this proliferated, right? We at the NYMEX back then, we owned our own clearinghouse, which is similar to what we're doing here at Abaxx. So when you control your clearinghouse, you can obviously with your partners in the exchange, like our clearing members and the trading community and the broker community, find markets that need to be addressed, whether it's for risk management, for price discovery, for better transparency, and go down the development road of building these products, launching them based on price reporting agencies, not on the physical benchmark, and help the marketplace. And that's what we did. And over the course of my 12 years that I was at the NYMEX, and through the Clearport platform growth and development, we launched almost 2,000 products. And when the exchange only had 5 for almost all of its history. The problem with that is there was no underlying physical markets to most of those contracts. Marketplace was fine with it because they had Henry Hub, WTI, Brent crude oil as kind of the genesis of pricing. and they were okay trading differentials to those, but there was no real underlying physical futures benchmarks to all of those almost 2,000 contracts that we listed. It served a purpose in the marketplace, but things that have happened over the past few years have pointed to, this doesn't work for everything. It's not a one size fits all. So we can get into that in some of the other discussion, but that's probably a good way to set the foundation of why we got to where we are today. What was the genesis of the financial futures markets versus where we need to go now?
And how significant are the physical benchmarks to the commodities trading?
They're extremely relevant and important. They're crucial to the price discovery process of the marketplace. You can't go to a trader and say, where do you think the price of the market is today? Because obviously he's generally going to try to trade his book. We had issues with that during LIBOR back in the 2000s, and that was not a good ending. And so the marketplace needs a underlying physical benchmark that's regulated, that can trade basis or differentials too, but you have to start with a pricing point somewhere. You need a real hub or something that correlates to the physical marketplace. And right now there is absolutely nothing in the global LNG markets that correlates back to physical waterborne LNG. And that's what we've been working on for the past 4 to 5 years on developing through our interactions with the trading community. What is the best thing? You can't do this in a vacuum. You can't do it in a think tank somewhere. You have to do it with interaction with the marketplace. And we feel that we have the best relationships with the marketplace, traders, brokers, clearing firms. They're all our partners. They've all contributed in a big way to the development of the products, and that helps you get at least something that's going to be usable in the marketplace.
In your opinion, of course, what would be some of the potential risks associated with financially settled benchmarks?
Well, the marketplace has told us over the past few years that some of the issues certainly are related to settlements. So how are settlements derived? How do they come to a number every day? Is it via calling up, as I said, calling up the trading community? Is it looking at chats? But overall, it's not based on actual transactions, and that's really transactions that are tied back to a physical benchmark. So it is a financially settled marketplace, and the market has said to us, we need something both from a risk perspective, a price forward pricing curve perspective, even to the point of audit trails. A lot of major trading firms have issues in their financial auditing procedures where they can't match a financially set of products against what they're marking their physical cargoes against. So it's called the phys-fin, and that phys-fin mismatch is causing a lot of issues. And for lack of anything else, the marketplace has been using for years totally uncorrelated products like Brent crude oil, Japanese crude cocktail. JKM has been a financial instrument that, for lack of anything else, has traded because there is no physical waterborne benchmark for that marketplace. So there have been a lot of instruments that have been used, but when you look at the correlations, they're completely uncorrelated.
You spoke in the beginning a little bit about your participation in the upcoming summit. What are you most excited about?
Yeah, I've been involved in the Japan energy markets for going back to my early days at the NYMEX when we were building Clearport. We had one of my colleagues who was working for me at the time was based in Tokyo. We were looking to expand our markets to the Asian region. We started with Japan because he was living there, but we know that it's a very difficult market to penetrate. You have to spend a lot of time there. You can't just parachute in and try to build a relationship. It takes a long time. I've experienced that. I think a lot of my colleagues have. And so we know that it really is building trust in the marketplace and bringing products to the marketplace that they can see that they can use. And we feel that this event gives us, as it did last year, a great foothold in the region. We know we have to, continue our education. I think education is the most important part, but our education of the community, the trading community, to our products. But a good example is what has been done with the power markets in Japan. They've grown tremendously over the past few years. And so that's just a point that they can adopt new ideas and new trading methodologies. And we know that our our physical LNG contract, especially one that's deliverable into Japan, will bring the most direct correlation to their use of LNG for power production for industrial use versus what they're using now, which is basically either a Brent crude oil contract, which is half a world away, that doesn't even have Brent crude oil mostly in its product anymore, or something that like a JCAM contract that's financially settled that is based on just on the way they settle. It just isn't usable in the marketplace.
Joe, thank you so much. This was such an insightful conversation. Before we go, just a quick reminder that the Japan Energy Summit and Exhibition is going to be taking place between the 3rd and the 5th of June, and you can register at japanenergyevent.com. A big thank you to everyone who is watching. Don't forget to follow us on all of our social media platforms to be alert with the latest energy news. See you soon with another Energy Connects discussion, and until then, goodbye.